The private business owner across that lunch table had the same income as the Fortune 500 executive sitting next to them. The executive paid his full federal income tax rate on every dollar that came through the payroll before he saw a single one of them. The owner paid significantly less, legally and every year. Same income, completely different structure. And the structure made all the difference. When I began to understand what separated the two rooms, the executives and the private owners, I expected the difference to be in investment strategy, in savings rate, in discipline or timing. It was not primarily. The most consistent difference I observed, the one that compounded faster than any investment decision, was structure. The executive's money ran through payroll. The owner's money ran through an entity they controlled. Same income bracket, completely different relationships to every dollar coming in. That one structural difference is worth more than any accountant's advice on deductions, because deductions reduce your taxable income at margins and structure changes the entire framework your income runs through. And most of the people this community was built for have never been taken here. That is what stage 2 is. That is why this episode exists. Here is the difference nobody puts in the financial advice video. The executive's dollar was taxed before it reached their hands, before they saw it, before they chose what to do with it, before they made a single financial decision about it. The tax bill was already calculated, already deducted, already gone. The owner made the structure decision first, which meant they decided what to do with the dollar before tax bill was calculated. The sequence is different. The outcome applied to every dollar every year, compounding over a working lifetime, is completely different. Same income, same bracket, different sequence. That sequence difference is stage 2. And most of the people this community was built for have never been shown it. The IRS always categorized income differently depending on how it flows to you. That is not a strategy or opinion, it is the structure of the tax code itself. It has been there for generations. Most people were just never shown it. And here is how it works. When your income comes through payroll, a W-2, the IRS calculates your tax before the money reaches you. The sequence is fixed. You earn, the government takes its share. You receive what remains. You have no decision point in that chain. The structure makes the decision for you. When income flows through a business entity, a Schedule C sole proprietorship, an S Corp, an LLC taxed as a business, the sequence is different. The business earns first. The business directs spending on legitimate business activities. Tax is calculated on what remains after that. The decision point exists before the tax bill arrives, not after. Same income, completely different sequence, and that sequence difference applied to every dollar every year across a working lifetime is what the tax code has always allowed. It is not a loophole. It is not aggressive. It is the way the code was written. Congress designed it this way deliberately to incentivize people to build businesses, create jobs, and take on economic risk. The people this community was built for were never taken into this room. Not because it was hidden, because the system most of them work inside, payroll never required them to see it. The structure made the decision before they had a chance to. Stage 2 changes that. Own the structure. Stage 2 of the SAWPOW applies when you are building from $10,000 to $50,000 in assets. But the structure decisions do not wait for the money. You build the structure before the money arrives. Because if you wait until the money already there, you have already left something on the table. 3 components in this sequence. Component 1, legal documents. A will, named beneficiaries on every account, bank accounts, retirement accounts, any insurance you hold. This is not optional and it is not expensive. Without it, in most states, the courts decide what happened to your assets when you cannot. Not your family, the courts. This week. Component 2, entity structure. If you have a business, freelance income, rental income, or any asset generating activity outside of a single employer, this conversation belongs on your list. An LLC separates your personal liability from your business activity. It changes how income flows. It is not something to do based on a video. It is a conversation with an attorney. But knowing it exists and knowing you need it is the structural shift that starts at stage 2. Component 3, first formal tax strategy session. Not filing, strategy. There is a fundamental difference between the two. Filing is looking backwards at the year that already happened. Strategy is looking forward at the year you are in with a CPA who understands your income structure, your entity, your goals, and your stage. Most people the wealth industry forgot have never been taken into this room, not because they cannot afford it, because nobody thought to show them the door. I want to be precise about something before we move on. What I have started here is a framework, the concept of an entity structure, the idea of a formal tax strategy, the importance of a will and named beneficiaries. These are educational concepts. They apply at stage 2 of the SOPA. I'm not your attorney. I'm not your CPA. Everything in this video is education, not advice for your specific situation. What this knowledge does is prepare you for those conversations. When you book that CPA session, when you call that attorney, you will come in knowing what questions to ask and why they matter. And that changes the quality of every professional conversation you have from this point forward. That is the purpose of this community. Not to replace the professional, to prepare you for them. If stage 2 is your stage, it will confirm that and give you your specific focus. Here is your one small seed for this week. Book a CPA session, not to file, to plan. Or call your existing CPA or find one this week and say, I want to talk about my tax strategy, not this year's filing, the structure I am building for the next 5 years. That one conversation is worth more than any important decision you will make this year. Episode 6 is the last episode of our blueprint. We go to stage 3. And stage 3 is where the Rockefeller family discovered something in 1913 that most people still have not found. Plant the seed today that shades you or someone you love tomorrow. See you in the finale.